Hello, Marc Ostwald from ADM Investor Services International, with some observations on where we stand at the moment in terms of markets relative to the news that we're getting on the spread of COVID-19. And it's with that I would like to start today. My first chart um, is from World Info, and it basically is showing that we're still seeing a fairly rapid escalation in new infections. There is better news, obviously, on terms of fatalities, but in terms of the infection rate, we are clearly seeing that it is not being got under control. And by extension, there are enormous risks in terms of the global economy of renewed shutdowns, as we're seeing in a number of countries in the US, Australia, localized in the UK, and obviously a rapid escalation in countries in South America. How are markets reacting to this? Well, it's the usual story with financial markets. Markets are very ambivalent, but there are reasons for that. My second chart today is to compare 10-year yields in the US, the UK, and Germany, which all show exactly the same pattern. We had an enormous drop into mid-March when the shock first hit, but really since mid-April we've been going sideways, barring a little bit of optimism as we reopened at the beginning of June. But since then, obviously, the spread of the infection rise and the infection rate has really not given us much encouragement. Perhaps just notably in passing, the UK 10-year yield didn't react at all this week to the 30 billion mini budget program announced on Wednesday. Not really surprising when one puts it in the simple context of that represents about 1.4% of GDP, and UK GDP is expected to contract by about 9% this year. So it's small beer in the greater scheme of things, and there will have to be a lot more spending to be done. So that's rate stability is an important thing to bear in mind because A, the yields are low, and B, they're not doing anything. So we're talking about a lack of volatility in interest rates. The third chart today is to compare China's CFETS Yuan index against the US dollar index. And there's a similar sort of pattern here in the sense that we had some volatility in foreign exchange markets during March, above all in the dollar. But basically since then, we're back into the same sort of sideways trend that we've been for quite some time. And it serves as a good reminder for the people who observed that the Chinese yuan went back down through 7 against the dollar this week, that the yuan dollar rate is not the be all and end all. This, and to a certain extent, that is just a reflection of a weaker dollar overall, which one can also observe on that particular chart. So what about so-called risky assets? For my fourth chart, and I think this is an instructive one because we've basically seen some sort of divergence here, is we've got the Nasdaq 100, which has obviously been reaching new all-time highs this week. Seemingly running against the grain of what we're seeing, but it really represents a bet on the future, that technology is the future, and tech-heavy Nasdaq is basically likely to be a beneficiary of that. And likewise, the better news from China on terms of the services PMI getting to the sort of levels which implies a significant pickup, a significant recovery, is also helping to power the CSI 300, even if it did have a bit of a tail off at the end of the week. My final chart, however, is a reminder of that real world syndrome, and that's that for all that the indices are being helped by low interest rates, low volatility, when oil decides to tail off, and it does seem to be teetering at the moment on the back of a pessimistic outlook for oil demand. So the S&P 500 struggles to actually break the bounds, as it did only in April, May, of a downward drag from oil prices. So just some thoughts for this week, and I look forward to speaking again next week.